Bank runs are largely a psychological phenomenon, and the concern is always that contagion starts to spread and things can progress badly very, very quickly from there. So that's the problem that the government have at the moment, and I think that's why they're doing whatever they can at the moment to try and quell fear, bailing out depositors when they have to.
Welcome to the Wiggin Sessions. I am Addison Wiggin. Today I have with me Phillip Patrick from the Birch Gold Group. Phillip spent some time on Fleet Street, London's version of Wall Street, for those who don't know. He was a wealth manager there for a while, and then in 2012, he joined the Birch Gold Group, and he's been there ever since. We have a lot to talk about with the banking crisis, the debt default in the federal government, and also most recently the Fed quarter-point rate hike. So welcome, Phillip. We haven't actually formally met before, so this is a good chance to get to know you and have a good conversation.
Well, thank you so much for having me. It's an honor to be on the show. Thank you.
Before we get started with the topics for today, why don't you tell me a little bit about yourself and the Birch Gold Group?
As you said, I was an ex-wealth manager. I worked for Citigroup for many years. I've been with the Birch Gold Group since 2012. In that time, we've become one of the biggest precious metals brokerage companies here in the United States, and we help families protect retirement accounts and cash with physical precious metals, which in climates like this are very conducive and very important.
Recently with First Republic, we saw a third, and actually the second largest in U.S. history, bank failure. We've had 3 of the 4 largest bank failures in the last 6 weeks. Immediately following the collapse of First Republic, Jamie Dimon, who's the chairman of JP Morgan Chase, who ended up buying First Republic outright in a deal backed by the FDIC, he said, everybody should take a deep breath. This part of the crisis is over. Just 2 weeks before that, he had said, this crisis is not over. Even if it is over, the ramifications are likely to be felt for years to come. So, and then like 2 days later, I think it might even be the next day, PacWest got whacked for 50% in the market because they had made the announcement that they had to raise a new round of capital to cover their depositors. So the day after Jamie Dimon was suggesting that we all take a deep breath, another regional bank gets hit by the market. So what's your view? Do you think this crisis is, I feel like we're in the early innings.
Yeah, it definitely feels that way. And there's a lot of banks out there that bought long-term treasury bonds. And obviously, since the Fed has been raising interest rates, their capital now is worth a whole lot less. According to the FDIC, the banking system was undercapitalized by $620 billion at the end of 2022. Every time the interest rate goes up, those losses now start to escalate. First Republic, to get a little bit of context, had about $20 billion of those losses. So there's at least another $600 billion sort of hole in banks' balance sheets out there. Now, as you mentioned, to put this into perspective, we saw bank collapses back in 2008. There was 25 banks that failed that year. These 3 banks that have failed so far this year had more capital than all 25 combined that failed back in 2008. And I don't think there's any simple resolution. And I think, as you say, things will get much worse before they get better. Credit is already tightening quite significantly this year, and we're seeing more banks starting to teeter at the edge of default. So certainly I expect to see more. I think this could be the beginning.
Another thing that happens, and we saw this when PacWest made their announcement, there were 3 or 4 other regional banks that got hit by the market that didn't indicate that they had a depositor, short lays. The danger of a bank run, a widespread bank run, is that it even starts in the market anyway, it starts to take down regional banks that don't have problems. And we saw that almost immediately. Actually, we saw it in the same trading day. Oh, and another example that I've been just noodling over is the curious case of Charles Schwab, who has a banking unit, but most of their business is a brokerage, but they've been getting hammered by the market as well. In fact, we indicated that it's a buy because we think they're unfairly punished by just investor fear. That whole sector is really in trouble, and you can see it. And as soon as somebody indicates, like PacWest did, that there's going to be a problem down the road, the market just bails.
It's absolutely right. And you raise a very interesting point. Bank runs are largely a psychological phenomenon. And the concern is always that contagion starts to spread and things can progress badly very, very quickly from there. So that's the problem that the government have at the moment. And I think that's why they're doing whatever they can at the moment to try and quell fear, bailing out depositors when they have to, because if contagion sets in, this whole system comes collapsing. So yeah, it's a very, very tough situation, and having to bail out depositors at a time when the government is so cash strapped, I think creates a whole nother issue, right? And we're seeing that now with the debt ceiling debate. We're seeing it with US national debt. Our tools to address the problems are slowly dissipating. So yeah, it's a big issue in front of us.
One of the numbers that we keep putting out there is that the FDIC only holds, at one point it was $130 billion in its war chest. They just used up a huge chunk of that, something like 26% of that, to support the First Republic deal.
Yeah,
they're going to run out of money quickly soon too. It's like nobody saw that rising interest rates were going to cause a banking problem, and nobody put more money in the FDIC war chest. So they're left to special situations. They're left to special bailouts again. And that's exactly what happened in 2008. They had to resort to just bailing out banks. And still, across 2008 to, I think it was around 2015, 440 banks failed. And like, we just kind of whisked it over with drop to zero interest rates and then massive quantitative easing. If we're in the early innings of this banking crisis and already 3 of the largest bank failures have happened, this could get ugly really fast.
I absolutely agree. And we don't have the tools to sweep it under the carpet this time around, right? The Fed can't just lower interest rates, start pumping money through the markets to stimulate economic activity, because that's going to fuel the dumpster fire of inflation that they created by doing that in the first place. So I think now things are a lot tougher. And like I said, I think we've got just numerous problems at the moment. It's almost like a case of whack-a-mole. You deal with one and another problem rears its head. It's a very tough situation. I feel sorry for the Fed at the moment because they've got an almost impossible task in front of them rather.
Yeah, as we're speaking, the Fed just raised another quarter point.
Yep.
And that actually was met by the market sell-off.
Yep.
And the idea is that if they keep raising rates, the banking crisis is going to get worse. People were started selling banks, and then it's spiking more concerns about a recession, which is going to hit the middle class, who are already strapped, but the same on from any of the pandemic or stimulus checks, and their consumer credit is at an all-time high, over
$1 trillion. Yeah.
It just makes you wonder, what is the Fed thinking now? Do you think they're going to pause?
Yeah, I think so. But, and this is why I say it's a very tough job, because if they want to combat inflation, they're going to have to get higher with rates. But as you say, the higher the rates go, the more it squeezes the banks. And I think if the Fed had to make a choice between saving the banks or combating inflation, I think they saved the banks time and time again. So I think, at least for now, I mean, this quarter point was fairly predictable. I don't think they're going to raise too much more between now and the end of the year, because I just don't think they can. Number one, it squeezes the banks. Number two, it squeezes the federal government. Don't forget, with $31 trillion in debt, every time that interest rate goes up, it adds a huge expense to the federal government. And I think that's why, ultimately, another reason why the inflation problem is going to be difficult to quell longer term. This 2% target for the Fed could be a pipe dream for the foreseeable future.
Yeah, and it really, the inflation issue, as you alluded to earlier, is a creation of their own.
Yeah.
A long period of time with zero interest rates, people get used to it, consumers get used to it, banks get used to it, Wall Street gets used to it. We had almost a decade of it. There's a lot of people that are in the market that only lived in a zero interest rate market. So the idea is that people don't believe that it's going to change.
I mean, it has to, right? And people, you're correct, they lose context. The federal funds rate today is what, 4.75 to 5%. The average federal funds rate in US history is 4.6. This is not a high level of interest rate historically. We're a hair above the average. So we've gotten used to cheap money, almost like a drug. It drove incredible growth in housing and stocks for a long time. But the problem was, in large part, it wasn't driven by fundamentals. We weren't seeing corporate earnings skyrocketing. In large part, we created a bubble. Now, we also created inflation. So now we have to take the air out of that bubble. The Fed have kept talking about a soft landing, which in my mind is another word for recession, but it doesn't really exist. Ultimately, the bigger the bubble you create, the harder the fall. And, you know, this has been from our own making. Now we have to suffer the consequences, sadly.
Yeah, and we've seen this repeated time again. I've been working on a new edition of a book I wrote called Financial Reckoning Day, where we look at bubbles throughout history. But specifically, we look at Greenspan's tenure at the Fed, where he had to deal with 1987, and then the Mexican crisis in 1984, and then LTCM in 1978, and then the tech wreck, and then the housing bust.
Yeah.
And he met each one with dropping rates, to the point where that became the norm. And then Bernanke continued with his helicopter policy. Yellen just dropped it to zero. It's like she abdicated her idea of managing money at all. So I wonder just your ideas on how we might get out of this.
I mean, look, it's going to be a tough ride, and for me, one of the biggest issues is the debt problem. But I think politics bleeds into this as well. Look at what's happening with our dollar internationally. We're seeing huge exits from the dollar, both from our enemies as well to some degree as our allies. So a lot's going to depend on what happens there, right? I think if we lost a grip on global reserve currency status, it's very, very difficult to come back from that, right? So I think that we need to start making some smart decisions. The debt problem looks at this point unsolvable through traditional means. So I don't know how we get through this, but it's going to take some smart political decisions. I think we've been outmaneuvered to some degree by the Chinese over the last 3 to 5 years. We need to make some changes. We need to be moving on a better trajectory. But economically, I think prices have to come down, right? We've been living in an unrealistic environment for over a decade. We need some reality to set in, and sadly, that means recession, right? We have to have it, I think.
Speaking of the debt, we're bumping up again against the debt ceiling, and it becomes a political football. You're talking about smart decisions, political decisions.
Yeah.
Isn't that kind of an oxymoron?
Yeah, it seems to be these days, but I think that's part of the problem, though.
So it seemed ironic to me that Janet Yellen was chastising Congress for playing politics, with the debt ceiling debate and warning that by even as early as June 1st, the government won't be able to pay the bills that it has already racked up.
Correct.
That's better known as a default. And the last time we defaulted was in 2011, which was on the tail end of the bailout period. How do you see the debt debate unfolding? It's kind of interesting. I know that you've been working with the Birch Gold Group since 2012. I assume you're as well accustomed to American politics as I am. But it is interesting to see you're English by birth, and you worked in London for a long time. It's just interesting to hear your point of view on the nightmare that is American politics these days.
I mean, it's disastrous, and I think the debt ceiling showdown is a very good reflection of that. I mean, look, McCarthy, I think, passed a budget recently that is fairly sensible, right? He wants to extend the borrowing limit by $1.5 trillion through March 31st, or until we run out of money, whatever comes first. He wants to cut government spending by 9% generally, right? That just brings government spending back to last year's levels. And he wants to cap spending increases by 1% annually for 10 years. Like, let's think about what this is. To me, it seems like a genuine attempt to negotiate. Cutting spending to last year's levels, it's not a lot to ask. We spent $6.27 trillion last year. For a little bit of context, it was the third biggest budget last year in US history. And we've got the Dems whining about slashing spending, right? Let's be clear about something. This proposal is not austerity. To me, it seems like an olive branch. And then we look at the response from the White House. They're demanding a no conditions increase, right? They want a blank check for unlimited debt finance spending. Now, listen, I know Biden isn't a mathematician, but this should be fairly simple to understand for anyone who's lived in the real world. If the government runs a deficit and increases debt, then sooner or later, they've got to generate revenue to tackle that debt problem. And it's done in one of two ways. You either raise taxes, you cut costs, or you do both. Otherwise, debt explodes over time. It becomes unsustainable, and that's what's called a debt trap. It's happened time and time and time again throughout history. We're clearly heading down that path, and I think the unwillingness to negotiate or even discuss spending is very difficult to rationalize. Politics has become absurd. This is a game of chicken, and we're talking about the nation's future. I think it's bananas.
Yeah, well, I don't think anyone accused Biden of living in the real world ever.
No.
Well, I think we're in agreement on that. Here's another issue that I think comes about. If the debt ceiling sort of takes over the news cycle and they're just playing politics with it, they're going to come to an agreement at some point because they can't afford to have a default.
Correct.
That doesn't mean they won't. They could just be idiots about it and not come to an agreement. But I assume that they will. That takes over the news cycle. In the meantime, the FDIC is trying to come up with money to help out banks, and the Fed is trying to fight inflation. It's a rock between a hard place and a rock and I don't know, a piece of granite or something like that. Or titanium, something stronger. Like, it's just unbelievable. And I've been writing about this for almost 30 years now. We have been talking about how absurd it is for that period of time. Like, each crisis seems absurd, but then the next crisis is even more absurd. And this one is like, I don't know how absurd squared. Stronger than absurd.
Yeah.
Like, it's if you understand history, if you understand economics, like, it's predictable.
It's absolutely predictable. A lot of the problems that we have been, right, and we've seen it play out time and time and time again in history, and yet we're falling for the same trap. It's absolutely bonkers.
The IMF recently came out and said they're expecting slowing global growth across all of the major Western economies, the developed world, and then identified China and India as the most likely place for growth in the next decade. How is that going to impact this absurd situation we find ourselves in?
I mean, it's just, I mean, it's very clear what's happening, but you're right. The IMF report, I think, forecasted global growth 50% lower than average. So this is not a domestic problem only. This is a global issue. They predicted that it'll take 5 years for global growth to recover just back to average levels. And like you said, they're suggesting most of that growth will come out of Asia, not the West. So it's very much concerning, but it's not the only indicator. Domestically, warning signs are flashing, right? Look at the Treasury yield curve inversion. It inverted on the 2 and the 10 13 months ago. Recession historically follows 12 months afterwards, right? It's a very accurate indicator of recession. The Conference Board leading economic index for the US fell by 1.2% to its lowest levels since before the pandemic. So yes, I think what we have is a recession. I think it'll be global in nature, and I think it could take longer to shake out than the previous recessions. When we think about '08, when we think about 2000, we had tools back then, right? In '08, we dropped the interest rates, we pumped money through the markets, and we stimulated growth. Today, we don't have the ability to do that given the worldwide inflationary problems, levels of debt. So rescuing the stock market doesn't seem feasible. We got to let it play out. Then you consider the inflationary problem, right? Like I said, I think the Fed are going to struggle with this, right? Last time inflation was at these levels was in the 80s. It was burning for a decade until Volcker came in. He got aggressive. He put the interest rate double the rate of inflation and he stamped it out. We have no ability to do that today, right? If we got interest rates anywhere near that level, it would cripple the government with debt service. So we don't have the tools to get out of this. We've got to let this thing play out. And that's where I think smart political decisions will come into play. Some austerity at some point will be necessary. And if we can do that, we can turn the course, but it'll take some time, I think.
Yeah. Well, one of the things that I've said on occasion is that the Federal Reserve is like the Federal Reserve of the world, because they start making decisions then, like when they started raising rates, you saw Bank of Europe, the European Central Bank, do the same. Australia and New Zealand have been following along. Even Japan was talking about it, which they hadn't talked about for. So we have exported inflation to most of the developed world, and with the amount of debt that all the governments carry, it's really hard to see how growth can return even in 5 years. Like, how does that debt the only way the debt actually gets paid off is through inflation, and then it's individual investors, it's the middle class, it's like people that aren't even in the market that pay the price, or government malfeasance, basically.
And you're right, it's always the middle class, right? We're the ones that suffer. So yeah, it's a disastrous situation.
If you say smart political decisions, what do you mean? That government spending is going to happen?
Well, listen, we have to reduce government spending. We have to sort of secure our presence on the international stage. I think we have to revert to manufacturing here in the United States. I mean, there's a lot of things that we have to do to bring ourselves back. But like I said, it's going to be a long fight. 2024 is a tough job for anyone who wants it. I mean, it's a thankless job in my mind. We've got so many different problems on the horizon. But I mean, yeah.
The push towards climate change initiatives, because that, instead of focusing on these issues, the politics of it is that we should be converting into a low carbon energy environment, and that's costing a lot of money too.
It is. And Look, the technology side of that is something that I don't understand as well, but I do understand the economic side. And I think Germany, look, there's no country more advanced in terms of green technology than Germany. Look what happened when a Russian pipeline was shut down. Look what happened to the German economy. So my feeling is, if the Germans weren't ready for this, what chance do we have here in the United States? I love the idea. The theory is wonderful. There's questions. Number one, is the technology workable? Can the grid in the US support that sort of thing? My understanding is no, not as it is currently. So it doesn't appear that we're ready. And until we are, why are we making decisions like closing pipelines here in the US? Energy independence is a large part of what makes us strong. To start to cut that at a time when we're not ready to move to green energy feels nonsensical to me. And it doesn't make sense.
Tell me about Birch Gold Group.
So Birch Gold Group, we deal with physical precious metals, and we have for, over 10, 15 years, I think now, been helping American families protect either retirement accounts with physical precious metals or for cash purchases with physical metals, but we deal with physical, tangible precious metals.
We have been advocating that people own a portion of gold in their portfolios. How does gold act in an environment like we have, where there's not a lot of tools to fight debt, politics, inflation?
Of course.
Gold generally does go up, and we just crossed 2,000.
We did.
And this is the first time we've crossed 2,000 and it stayed above. So where do you see it going from here? We forecast that it would go to 3,000, but
look, I think 3,000, I think, is a feasible number. Look, at the turn of the century, essentially since the beginning of the quantitative easing era, gold was at 300 an ounce. Right now, we're just shy of 2,050, I think, today. So we've seen a 580% gain. By the way, I always say, for most of the 20th century, one didn't buy gold for growth, right? You bought it for preservation, you bought stocks for growth. This century, since the turn of the century, since January 3rd of 2000, gold has outperformed the S&P quite significantly. And I think it's no coincidence that it is in this era of quantitative easing. But the point being, if we look at that long-term gain, we look at how quantitative easing has escalated, if it just continued on this trajectory, it would hit 3,000 in about 2 years. For me, that feels feasible. Now, as we've discussed, there's a lot of factors that will influence gold price, right? I think the Fed's inflation fight, as an example, will be key. If they struggle to control inflation, right? If we lose a grip on it, gold prices could go bananas on the back of that. So there's a lot of things that need to be ironed out. But like I said, if it just continues the same trajectory it's been on, 3,000 should be achievable within the next couple of years.
How do you recommend that people, when you have clients that come in the door, how do you recommend that they acquire?
It just depends on the individual, right? But we deal with the physical precious metals. We think there's a lot of advantages to that, right? We're looking at what's happening with banks now, paper assets disappearing with balance sheet, having to get bailed out by the government. That sort of risk, counterparty risk, doesn't exist when you own a physical commodity, right? Look at the currency problems that we have. Whenever currency's up in the air, the physical nature of the investment is important. Physical gold is in on itself a form of currency. So like I said, we deal only with the physical commodity. How people purchase really depends on where their exposure is and where their concerns are. Some people purchase with cash in a bank that's losing to inflation. They want to take possession of the physical metal and hold on to it. Others have their retirement in IRAs. They can roll over any portion of an IRA without tax implications or penalties, and we can place physical precious metals tax deferred within retirement accounts. So just depends on the individual and where their concerns lie.
So if somebody wanted to get in touch with you, what's the best way to do that?
It's really simple. The best thing to do is you start with information, and they can, for your viewers, they can get information very simply. It's birchgold.com/kit. KIT. So birchgold.com/kit. And what that will do is give them access to a free guide. It's, I think, 25 pages, has a lot of information on how to invest in precious metals. So it's a really good starting point. And from there, there's a lot of people like myself at the firm that are there to guide people through, hold their hand, and sort of walk them through the process.
That's great. Well, thank you, Philip, for joining me today, and we will stay in touch. I'm actually interested in your kit myself.
Well, thank you so much for having me. It was an absolute pleasure. I really enjoyed the conversation. Thank you, Addison.